In this video, we're going to see how you can pick the best stocks possible for the covered call strategy. I'm going to show you how I personally choose stocks when using the covered call strategy, what am I looking at, so hopefully it's useful for you if you want to do the same in your own trading. But before diving into this video, if at any point you find this video interesting or helpful, please consider subscribing to my channel. It's free, it helps me a lot, you can't imagine. When you sell covered calls, the hard part is not necessarily executing the strategy in itself. It's not necessarily the hardest. What's way harder than this is to find the best stocks possible for the strategy, because there are plenty of mistakes that you could do. First of all, let's do a small recap of the covered call strategy if you're not very familiar with it. The covered call strategy consists in buying 100 shares of a stock and selling calls against it. We typically use this strategy when we are neutral on the stock or slightly bearish or slightly bullish. If the stock goes down, then your call is going to expire worthless, and in that case you can keep selling other calls so as to reduce your cost basis. Or if the stock stays where it is at expiration, then if you stole an at the money call, then your call is going to expire worthless, and in that case you can just keep selling other calls so as to reduce your cost basis. Or the stock goes up and your call expires in the money, and in that case if your call expires in the money, then you're going to be assigned and you will need to sell 100 shares of the stock. And as you already have 100 shares of the stock, then you just end up selling the shares that you have and you end up flat. And if you have sold your call at a strike that is higher than your cost basis, then you will make a profit overall in the process. So to sum it up, the cover call strategy can be used if you're slightly bullish, if you are neutral, or if you are slightly bearish. However, there are risks when using the covered call strategy that you really need to be aware of. And to understand why the stock selection is so important in the covered call strategy, we need to understand the risk of the covered calls. And very often when you look into covered calls, you just, type on Google covered calls or you watch YouTube videos about it, you're going to hear about one major risk. It is that when the stock goes up and then your call expires in the money, you basically miss out on potential profits. Because it's true, if you didn't have your call, if you hadn't sold the call and you just see the stock rising while you have those shares, then in that case you're just going to make a great profit. However, by selling a call, you're going to cap your profits, meaning that even if the stock goes to the moon, then you're not going to be able to actually take those profits. You're not going to be able to bank those profits because the call that you have sold will cap your profits. However, as much as it's true that there is an upside risk, meaning that as you're selling a call, you're capping your profit on the upside, it's not the only risk, and the downside risk is actually a lot bigger than the upside risk. And let me explain why. You see, when you use a covered call strategy, you don't really mind if the stock actually goes down a bit, and in a way that's also why it's used. It's very often said that covered call strategy is great when you have a slightly bearish assumption on a stock and you want to take advantage while owning the stock of an income by selling premium, by selling calls on that stock. It's true that it's very often said. However, covered calls are not going to work anymore if the stock falls too much. If the stock falls, let's say, about 20% overnight, then you will be stuck with a running loss, and it's going to, if it comes back, it's going to take a very long time so as to come back to a break even. And even if you will still be selling calls so as to reduce your cost basis, it's going to be very painful and very, very long. So yes, the covered call strategy works for slightly bearish stocks. However, it's not going to work if the stock falls too much. And that's where the real risk is about the covered call strategy. The real risk is not on the upside, because even if you are being called away on your shares, even if you miss a bit of profit, it's not really a big deal. What's a big deal, however, is if the stock falls too much, and it falls so much that you're just being stuck with your shares and you cannot reduce enough your cost basis so as to go back to the break even, and you're just going to be continuing trading with a huge running loss. So how can we avoid being in that situation? Is there a way that we can actually avoid being in that situation? And personally, and that's why I'm going to explain you how I actually choose the stocks and how I can find really great stocks for the covered call strategy. And let me explain. I have 3 criteria that I use when selecting stocks for the covered call strategy. The first criteria is that I want to choose quality companies. And what does that mean? When you decide to trade a very great company, a liquid company, that's something that is very reliable. Either, for example, it's like Apple or Facebook or 3M or AbbVie or any company like this. Because the company is so big and it's actually so settled, all the information is mostly priced in. What does that mean? Well, it means that you're going to avoid having very bad surprises overnight. It's going to be very rare that you see see a stock like 3M, for example, falling by 50% overnight. As I said, the risk of the covered call strategy is on the downside. If the stock falls too much, that you're going to be in a very big running loss, and by choosing quality companies, by choosing really companies that are known, where the information is priced in, you're going to at least ensure that the company is well known, that there is most of the information priced in already in the stock, and you're not going to have unnecessary surprises. Because what you don't want to pick as a stock using the covered call strategy, even if they have, for example, great premiums when you're going to sell calls, is, for example, waking up one day and seeing that the stock fell by 50% and now you're in a huge running loss and you cannot sell calls above your cost basis, so you're basically in a very bad position right now. And that's something that you really don't want to do. That's why choosing a great company when using the covered call strategy is really the best thing that you can do for your P&L, for your trading account. Don't try to go into those shady companies that not a lot is known by the public, because one day if an information comes out, then the stock is going to react like crazy, and if it goes down by a lot, then you'll be stuck with a huge running loss. The second criteria that I use when selecting stocks for the covered call strategy is the liquidity. I talk a lot about liquidities in videos, for example, on how I choose my strikes, and this is something that is very, very important. You want to choose a company that has very liquid strikes. The fact that you're going to choose a company that has a lot of liquidity by, for example, looking at the bid ask on how tight it is, or the open interest, you want to have high open interest for the strikes that you're actually choosing, is going to allow you to really have a lot of flexibility, and you won't be in any trouble when trying to get in or trying to get out of the trade with your profits. And I know that I've already talked about this a lot in my other videos. For example, in terms of open interest, I like to stick to strike with a minimum open interest of 200, for example, but this is really important stuff. This is really going to save you a lot of money, and if you don't check the liquidity when choosing strikes, then I definitely advise you to start doing so, because this is really going to save you a lot of money, a lot of troubles on the long term. So start looking at the liquidity of the strikes that you're choosing, of the stocks that you're choosing, so you make sure that you can actually get out of a trade with your profits. So now the last criteria that helps me choose the best stocks possible for the covered call strategy. So this is something that I like to do myself. As we know that for the covered call strategy, the risk, the very big risk, is on the downside, because if the stock, as I said, falls too much, then you're going to be in trouble. Now we understand that. Well, in that case, I want to choose stocks that are already at a discounted price. And what does that mean? So as to make you really understand, let's look at the opposite example so it's completely clear. Let's imagine that a stock is actually at an all-time high. The stock is actually going higher and higher and higher. Why would I want to sell a covered call on that stock? Because if the stock falls, let's say it corrects by 10%, for example, then I'm going to be stuck with shares at an all-time high and trying to sell calls just to reduce my cost basis, and the stock will just correct over and over. And to put it into words, the criteria is choosing stocks that are at the low end of their trading range. What does that mean? Well, I'm going to go for stocks that are actually being offered at a discount right now. And let me give you some examples so it's completely clear. For example, American Airlines. They've been in big troubles because of the COVID pandemic. Of course, like, they cannot fly the planes, so obviously all their planes are stuck on the ground, and their stock is also stuck on the ground. And the reason why I would want, for example, to sell covered calls on American Airlines is, as the stock already fell so much, I know that it has less probability of going even lower, because now we already went through the worst, for example, of the pandemic. So we know that the stock is probably not going to fall by, again, another 50%. It already fell so much. So I know that by selling a covered calls, my big risk, my big downside risk is actually quite limited on that stock, because now we can basically only see the stock rise, and even if it falls lower, at least I won't be in as much trouble as if I had sold a covered call on American Airlines when it was prior to the pandemic. That's why I like to focus on stock, for example, like American Airlines or Carnival Cruises. Their stock is already quite low priced right now, and personally this criteria helped me a lot, like, because I really think that if you, for example, buy shares at an all-time high and you start selling calls against it, yes, you can make money, and you might be right and you might make even more money, and that's great. However, know that the big risk of the covered call strategy is on the downside if the stock falls too much. When I started looking at cheap stocks that are actually quite cheap because of, for example, the current situation, but that helped me in a way that I know that by trading that stock, the stock already fell so much that I have quite low probabilities of seeing that stock falling even lower. And that's exactly what happened, for example, on Carnival Cruises. I've been selling covered calls on that stock, and now the stock is just even going higher and higher, and I'm just being called away on my call. And in that case, I just sell back the shares all for a profit, and that's great, and that's exactly why I like using that criteria so as to select stocks. After that, if you like to sell covered calls on stocks that are very high at the all-time high and it works well for you, then I'd say that's fair. However, what I personally notice is that when you do this, then you have a much bigger downside risk because now you're an all-time high and the stock never went higher than this, so you have more probabilities of seeing the stock coming back doing a correction rather than actually continuing the trend. So I'd rather sell covered calls on stocks that are at the low end of the trading range, so at least I know that the only way is up in a way because they already fell by so much, and I'd rather do it that way, and personally that works well for me. So if I have to sum up for the three criteria that I like to use, first of all, it's choosing a great company, then you're choosing liquid stock and liquid options, and the third criteria is choosing stocks that are at the low end of their trading range. I hope you enjoyed this video where I talk about how you can select the best stocks for the covered call strategy. If you have any questions, just comment it below, I'll be happy to answer. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.